Okay, so the next part of the module is about the concept of materiality. Okay, so information is said to be material if its omission or misstatement, may it be individually or in the aggregate, could reasonably be expected to influence the economic decisions of users taken on the basis of the financial statements. Or in other words, we can consider the information to be material if, for example, we omitted that amount or information. It will have the influence, or it will make a difference, okay, in the economic decisions of the users of financial statements. Or if that is not omitted, that is misstated and not corrected, it can still have the negative influence on the economic decisions of the users of financial statements. So this is how material information is essential or important in the gathering of the audit evidence, which will be the basis for the expression of the opinion of the auditor later on. Okay, so that is the concept of materiality. So it is material because it is able to influence the decision of the users of financial statements. Because, for example, if we omitted this information, which is considered to be material, then the users might have a bad decision. Okay, or if that information is misstated and not corrected, they will also have a bad decision as well. Okay, so meaning the auditor should include that to correct the decision making of the users, okay, as well as correct the misstatement, or they should be informed that it is misstated so that they should decide correctly and sound or economically. Okay, so judgments about materiality are made in the light of the surrounding circumstances, and this is often depends on the size and or the nature of the misstatement. So it may be a combination or both. Okay, so again, talking about materiality. So materiality is relative, meaning to say an information or an item may be material to one entity, but it cannot be material to another entity. So that's why the auditor should always perform the assessment of materiality with professional judgment, as well as asking, for example, the help of the entity, okay, on how they consider materiality, especially in preparing the financial statements. Okay, so thus materiality provides a threshold or cut-off point rather than being a fundamental qualitative characteristic which information have if it is to be useful. So meaning to say materiality is used here as a cut-off point. So again, this is especially important in the gathering of the audit evidence. So the auditor will only include those items or evidence which are considered to be material. Okay, so the auditor's determination of the materiality is a matter of professional judgment, which involves quantitative or in terms of size or amount of the misstatement, as well as qualitative. So like, for example, misstatements resulting from fraud, these are usually considered to be more material than those misstatements that is caused by errors. Okay, so this should be considered in the determination of materiality. Okay, so materiality also is expressed in relative rather than absolute terms. Okay, so meaning what is considered material, as mentioned earlier, for one person may be judged as immaterial for other parties. Okay, so that's why this is expressed in relative rather than absolute terms. So the International Accounting Standards Board, they amended the definition of the IFRS that is effective on January 2020 as follows. Information is material if omitting or misstating or obscuring it could reasonably be expected to influence the decisions that the primary users of general purpose FS make on the basis of those financial statements, which provide financial information about a specific reporting entity. So if you could notice in this definition, okay, it's quite comprehensive compared to that of the definition that we had in the previous slide. Okay, so here they have already included some of the most important factors, such as the information that is provided by the entity. Okay, so before it was not yet included. Okay, because in that case, the definition before was just for the decision making of the users of FS, but they did not include the responsibility of the party who prepared the FS. Okay, but this time they have already included it. And aside from that, the term obscuring, which means concealing. Okay, so it's like omitting actually, but omitting is they did not include it. Okay, they excluded it from the FS from the face of the financial statements. While obscuring means there is an item there in the financial statements, but they tried to conceal or hide it using another account, for example, or including the amount of that in another account balance or nature. Okay, so that's how they define materiality now. Okay, so that is for materiality. So in this video lecture, so we will continue with the next topic, which is related to materiality. So that is the auditor's responsibility with respect to the materiality in an audit of financial statements. Okay, so the auditor here should apply the concept of materiality both in planning or identifying and assessing the risk of material misstatement, as well as in the performance of the audit or the determination of the nature and extent of further audit procedures. So this is how materiality will be used, okay, during the conduct of the audit. Additionally, materiality should also be considered in the evaluation of the effect of any uncorrected misstatements. So if there are any on the financial statements, and informing the opinion also. Okay, so that's how essential materiality concept is in the conduct of the audit. Okay, so according to PSA 320, so this was revised and redrafted. So materiality in planning and performing an audit, the auditor should consider materiality at 3 different levels. Okay, so this is especially when establishing the overall audit strategy. So we have the overall materiality, which is materiality for the financial statements as a whole, specific materiality, materiality applied to a particular class of transactions, account balance, or a disclosure, and lastly, the performance materiality. So we will discuss each of them. Okay, first, when we say overall materiality, so this is the first area where materiality can be applied by the auditor during the conduct of the audit. So again, when we say overall materiality, this is materiality for the FS as a whole, or overall materiality is determined at the overall FS level. So this is like considering materiality in all the components of the FS, all the areas. Okay, so this materiality level will assist the auditor in determining whether the proposed audit adjustment are significant or not. So they will know and consider the factors, okay, for the adjustments. If the audit adjustments exceed this level, so the auditor may require that the FS be adjusted. Okay, because in this case, it might be that in the materiality have the impact on the overall FS already. So adjustment is necessary. So they have to require the management to adjust the financial statement because it is materially misstated. Okay, in calculating overall materiality, the auditor should identify the appropriate benchmark, which could either be the element of the FS like profit before tax, on which they will base, okay, the materiality level, or even total assets or total equity. So the auditor should then choose an appropriate percentage to be applied to that benchmark, and in determining the percentage to be applied also to that benchmark. So meaning to say, in the application of materiality, so the auditor will determine the appropriate account, for example, or balance, okay, that they will base the computation of materiality, and then the percentage as well on which to apply to that specific account or total. Okay, so the following factors are often considered by the auditor. First, for the overall materiality, first, components of the FS, what should be included, focus of the users of the FS, so where do they usually look or see, okay, information for decision making, the nature of the entity, ownership structure, okay, of the entity, the volatility or the change, okay, that is related to the benchmark or to the basis that is being identified, as well as the laws and regulations such as SEC, okay, and so on. So this should be considered in determining and applying the overall materiality. Okay, so in practice, the benchmark commonly used for profit-oriented companies, of course, is using their profit from continuing operations before tax. Okay, because in this case, taxes will be applied after the balances are corrected already. So that should be correct, because BIR will still recheck, okay, the accuracy of the income, so they will know if that is correct or not. So basically, they will have to pay for any understatement or be what do you call that, reimbursed for any over amount. Okay, so that's why in this case they usually use the before tax amount. Okay, so however, when there are circumstances that give rise to an exceptional increase or decrease affecting the chosen benchmark, for example, there are items which includes non-recurring gain or loss, meaning to say these items was just present during the current period and it's not likely to happen again in the future. Okay, so the auditor may use a benchmark based on the normalized profit before tax also from continuing operations, so excluding those items which are non-recurring. Okay, another, in determining the overall materiality, the auditor should consider that the FS are interrelated with each other. I mean, this should be the case. Okay, so because the items from the income statement, for example, will be used in the preparation also of our balance sheet and so on. So therefore, there is interrelationship between the components of the financial statements. Okay, so for instance, a statement in one account in the financial statement of a financial position could have the material effect also in another account in our income statement because they are interrelated. So in such case, the auditor will consider materiality in terms of the smallest aggregate amount of misstatement that could be material to any one of the FS, meaning to say, although that is small, when you add them together, it will create a huge amount which will now consider to be material. Okay, So, for instance, the auditor might believe that misstatements amounting to 50,000 could materially affect the statement of financial position, but he thinks that misstatements would have to aggregate to 70,000 in order for it to be considered material, okay, or materially affect the income statement. So in this case, the auditor would use the lower figure, which is 50,000, in planning, okay, and deciding on the materiality level, because this will give the auditor a reasonable assurance that both FS are not materially misstated. Okay, so that's how it is applied. Okay, so the next level of the application of materiality concept is in the specific materiality. Okay, so here, when you say specific materiality, materiality are applied to a particular class of transaction in an account balance or a specific disclosure. So, this is set by the auditor for which misstatements, although lower than that of the overall materiality, this could reasonably be expected to influence also the economic decisions of the users of FS, although it is just for a specific transaction, account balance, or disclosure. Okay, so again, if it is considered to be material, then it has an influence or effect or makes a difference in the decision making of the users of FS. So, in specific materiality, in determining this materiality, the auditor normally considers the following factors: laws and regulations, the framework or the standards used, key industry disclosures for that entity, the aspects of entity's business, understanding of the view of those charged with governance and management, because this might affect a specific disclosure or account balance on how they prepared it, okay, and incorporate it in the financial statements. Okay, and lastly is the performance materiality. Okay, so under the performance materiality, so this refers to the amount or amount set by the auditor at less than materiality for the FS as a whole. So this is quite short or minimal compared to that of the overall materiality. So the, less than the materiality for the financial statement as a whole to reduce an appropriate low level the probability that the aggregate or uncorrected and undetected misstatements exceed materiality for the financial statements as a whole. Meaning to say, this is set, okay, at the lower level compared to the overall materiality, because in this case, even though they are uncorrected or undetected, the misstatements are, although the misstatements in the aggregate level are uncorrected or undetected, so it may not exceed the materiality for the whole for the FS as a whole, because it is set at a lower level. Okay, so similarly, performance materiality relates to a materiality level that is determined for a particular class also of transaction, account balance, or disclosure that is set to reduce it to an appropriately low level. Okay, so this is like the specific materiality, but in this case, this is set at a low level. Okay, so that even if it is aggregated or it is undetected, or the misstatement are undetected or uncorrected, the amount of materiality will not exceed to the materiality applied in the financial statements as a whole. Okay, so the performance materiality considers the fact that several individually immaterial misstatements may cause the FS to be materially misstated as well. So in this case, this is just what we have mentioned before, that although the amount is considered to be material, but if we try to aggregate them, it will become material already. Okay, even up to the financial statement level as a whole. So, for example, if 150,000 is considered material individually, immaterial understatement of two asset accounts by 100,000 and 80,000. If we will try to add this will exceed the materiality level of 150, although these are considered immaterial individually. So in this case, it will still result into material misstatement. Okay. So therefore, performance materiality will ordinarily be set at an amount below the overall materiality or to the specific materiality if it applies. Okay, so although it is lower, still we will consider it as material, especially if this is aggregated. Okay, so performance materiality is used in scoping of financial statements line items to be tested by the auditor and ensures that significant accounts in the FS are covered by the audit testing. Okay, so even the smallest misstatement will be considered. So in determining the performance materiality, the auditor should consider the following factors also: the nature of the entity's business and transaction, risk assessment procedures, and the nature and extent of misstatements that is identified. So this will be, of course, related to the misstatement that may exist, okay, during the preparation of their financial statements. Okay, so that is for the auditors, or the concept of materiality and the auditor's responsibility with materiality in the audit of FS.